Welcome everyone today to Endeavour Wealth Management's 2020 quarter two investment and market update report here. I have with me today Craig White, investment advisor and portfolio manager with Endeavour Wealth Management. Craig's work here at Endeavour is focused on investment research and portfolio construction. So when we're looking to get an update of how portfolios have performed and exactly what we're seeing in markets, Craig's really the guy that we want our clients and investors to hear from here. So with that said, welcome, Craig. Thanks for taking the time today.
Oh, thanks for doing this.
Another quarter has ended here, Craig, and to say it was interesting would be putting it lightly. So for our clients and those who may be considering becoming a client, Craig, what would you say, how did the second quarter play out, and what would you say at this point in the markets?
Yeah, so I mean, 2020, as I think most people are aware, has been extremely volatile. The first quarter was disastrous for markets. Many of the indexes were down 20, 30, maybe even 40%, some of them. So the second quarter has been more of a theme of recovery. A lot of the indexes have recouped a lot of their losses that they had earlier in the year. And in fact, many of our clients are now, sitting close to or maybe just slightly under where they started the year at, which is, given where we were at in March, is definitely, I think, a good situation. But the underlying economy is actually deteriorated in the last 3 months. There's more people out of work. GDP numbers are not good. And coronavirus cases are still going up. So this recovery that we've seen in the markets is still very precarious, and I think caution is going to be definitely warranted going forward.
So with that said, Craig, for those who maybe haven't really followed the recovery as closely, or just for those who maybe even a little confused with what you mentioned there around uncertainty and everything going on, and what would you say to investors when they're wondering what exactly can this stock market recovery be attributed to?
Yeah, and it is confusing, and I can understand why people are confused because, as I said, the underlying economy is not good right now. So the markets, the companies that have done well in the markets there's really two types of companies that have done well. One would be technology companies that are actually catered to the COVID quarantine type situation. So things like e-commerce and Zoom video chats and things like Netflix, entertainment that's provided digitally. Those things have all done really well. The other sector that's done well is, of course, biotechnology, and there's pretty much a story every day now, it seems, that to do with coronavirus treatments or coronavirus vaccines. And typically when those stories happen, you get a big jump in the price of that company, whoever it happens to be on that day. So those two sectors have done really well, and they've kind of masked the weakness in the rest of the market because financial companies and energy companies and a lot of consumer discretionary companies are still well off of their where they were at the start of the year. So it's been a tale of two different markets. I think that if we're looking at these companies, like, investors seem to be really focused on businesses with growth right now, and the valuations and the prices that they're willing to pay are not that important to some of them. And a good example that I can see is a company like Tesla, and just so people know, like, I don't dislike the business of Tesla at all, and I hope that for the world's sake, that electric cars do become more prevalent. But Tesla's valuation right now, as of today, is somewhere around $250 billion. The biggest car company in the world by market cap, and they make about 100,000 cars. They made about 100,000 cars in the last 3 months. Toyota, who they supplanted as the biggest car maker, made about 2.7 million cars in the last 3 months. So, you know, Tesla is a good story, and it may well grow into a company that deserves a market cap like Toyota's, but they are not there yet. And so a lot of the valuation in the stock price is based on speculation and not real economics. So it's stuff like that that makes me a little bit nervous about where we're at in the markets.
And I know you mentioned just we've talked a lot about Tesla in the office here, and it's trading at 8 times their annual revenues, and they've only had minimal profits to date. And so I know we've talked a lot about how that makes it difficult to essentially value the company. And you mentioned it's not that you necessarily dislike the business, but the ability to come up with what you think that business should be worth today and what we'd be willing to put clients' money into is just for you at this point. It's too, I guess, gets into the too difficult pile.
It gets into the too difficult pile. I certainly wouldn't invest in it at the current price. I wouldn't short it either because I don't want to bet against it. But I think with Tesla, it's really a perfect storm of sort of speculative factors. You have a lot of growth. There's a lot of technology in it, which is a very popular thing right now, is investing in technology. That the Tesla itself is driven by the cult of Elon Musk, and Elon Musk is a celebrity CEO. I mean, he's hanging out with Kanye West and tweeting about it, and he has a rocket company. So like he's basically like Iron Man in real life. And on top of that, Tesla's cars are cool. Like they're fun to drive, and they're just cool. So you really have all these factors working together as positive impacts on the stock price. And when you throw all that in there, people kind of lose sight of what the valuation should be, and they don't really care what the price is. They just see that it's going up. And I think that's what's happened with Tesla. There may be a point where Tesla can get to a profitability level that justifies where their current value is, but they're a long way from that, in my opinion.
So if they disappoint, obviously shareholders buying in today at today's prices may be looking at some time before they get that money back. But I'm sure some investors may wonder why we're why we aren't jumping at an opportunity to own a company whose stock has had such terrific performance. And I know we're comfortable kind of watching from the sidelines. Maybe you could break down for clients and prospective clients what exactly our concerns are when we're making the decision to put clients' money to work and invest their money. So Craig, maybe you could just share a little more around our process there and exactly kind of why a company like Tesla essentially gets disqualified from investment opportunities.
Yeah, for sure. So we always start with the premise that our number one goal is we don't want to lose money. And the way that we prevent that, the way that we prevent losing money is we want to build in a margin of safety in any investment that we take. So what that means is there's a margin of error that we can have in our forecast for that company, that we can be really wrong or significantly off on our forecast and we'll still make money. And the way that we do it is by paying less than what we think it's worth. So, for a company, let's say I think it's worth $100 a share. Well, if I'm only paying $50 a share, I can be really wrong on what the actual value is, because let's say I'm wrong and it's only worth $75 a share. Well, if I had paid 100, I'm now losing money big time. But because I only paid 50, I've still made money, even though it was significantly worse than what I thought it was. So with Tesla, as an example, Tesla's trading at about 8 times of their revenues, which is an extremely high price to pay for something. And so there's no margin of safety to be had there. Like Tesla may, meet all of their objectives and meet all of their goals and justify that their current price, but pretty much everything has to go right for that to happen. If one thing goes wrong, the current price doesn't make sense, and people are going to lose money if they're buying it at the current price. So we don't like those types of situations. We like situations where it can go significantly worse than we think it will, and we'll still make money. And that's just not the case with Tesla.
And I know we've talked about this before, but that's just we could be wrong on Tesla's growth, but it's a mistake that our clients can live with. What they can't live with is if we're permanently losing capital because we overpaid for a growth company that didn't turn out as well as we thought. So, but speaking of retail investors, Q2 has been a heyday for the next generation of day traders. We're seeing, amateurs have really thrived during the quarter, while professional investors are getting criticized left and right here. Could you maybe shed some light on this phenomenon and what this might mean moving forward, Craig?
Yeah, so I mean, during the COVID quarantine, there was a lot of people that were signing up for free direct brokerage accounts through companies like Robinhood, and in Canada they were doing it through Wealthsimple and other companies. So there's been a lot of that happening just because I think, frankly, people were bored and there was something to do. I'm an avid follower of Warren Buffett, as I think everyone who knows me knows that. And Buffett and Berkshire have had a really rough couple of years in performance, and it's not it's not that they've somehow lost the mojo or forgotten how to invest properly. It just happened that they've had a couple of rough years, and in that same time period, there's been a lot of amateur investors who've done really well, and you see it there even in guys like Dave Portnoy at Barstool Sports are running investing shows now, and Dave Portnoy, I don't think he actually even believes what he says when it comes to investing, but he's selling it as an entertainment, and so that's what it's become. It's day trading has become entertainment during this COVID crisis, but it's leading to a lot of unsustainable and reckless behavior. I think all of this, amateur investing, and a good example of that is with the airline stocks, because Berkshire actually owned positions in all the four major U.S. airlines, and they actually sold them back in March. And they sold them because they felt that the business's quality of those four airlines had deteriorated to the point where they didn't want to own them anymore. During that same time that they were selling them, a lot of amateur investors were buying them, and the theory was that they had dropped so much that, hey, there's value here now, and I'm going to get in on this cheap price. And those amateurs have done really well in the short term, but I think it still remains to be seen what's going to happen long term with something like that, like an airline, because there was a story a couple of days ago where United Airlines is warning about half of their staff that they're either going to be furloughed or just let go. So companies that are letting go half of their staff, that's not a good sign for their future prospects. And I would be very concerned if I owned stocks in United Airlines right now.
Yeah, a lot of uncertainty for demand of air travel there, and I know, Craig, maybe you could speak to even the amount of debt that we're seeing airlines have to take on right now, and what that obviously means to their businesses, or can potentially mean to their businesses moving forward.
Yeah, for sure. I mean, the travel industry has been devastated, and we don't actually know what the demand's going to look like going forward, and that's one of the main reasons why I wouldn't invest. But a company like United is burning $40 million a day in cash just to keep their operations going, meaning that they're losing $40 million every day. And that money that they're using for that is new debt that they're taking on. So if you looked at the business of the airlines before COVID, um, what's happened during COVID is basically the demand is no better and probably a lot worse than it was pre-COVID. The businesses have taken on a lot of debt to survive during this time period, and there's just a lot of uncertainty, right? So, I was, uh, I think the airlines had reasonably good businesses pre-COVID, but you add on the debt and you take away a lot of the demand, and that demand might be permanently gone in cases of like business travel, because we've learned that you can do a lot of meetings through Teams or through Zoom, and you don't have to fly around the country to have these meetings. So that demand might be permanently gone, and so it's not a business that I think is very attractive right now.
Another example, and again, I know we've talked about this one in the office here because it's you know from our perspective anyways, complete insanity with some of the stocks that we've seen and some of the price movements. So the one I'm referencing here is Hertz Global Holdings. Hertz filed for Chapter 11 bankruptcy protection in April, and their stock essentially shot up in value initially after. So maybe you could talk a little bit more to Hertz and what we've seen going on there.
Yeah, I mean, it's another example of, I think, speculative behavior in stocks by amateur investors. Like Hertz is a bankrupt company. They are in Chapter 11 bankruptcy. They, in almost all likelihood, will end up being completely worthless. Their common shares will be worthless. And what happened though is that, again, people saw that the price had dropped a lot and that they thought that there was maybe some value there. So they started to buy, and these amateur investors bid up the price. And so it actually, I think at one point it was up, probably 300 or 400% from its low. And so it was really unprecedented because Hertz, the management decided that, hey, the share price is going up, so we might as well try and sell some shares to pay off some of the debt that we owe. And whenever you do a prospectus like this, you have offering documents, and in their offering documents, they that are supposed to go to the investors, they put in the risk factors, and one of the risk factors was basically saying, hey, this common shares that you're buying are in almost certainly going to be worth nothing. And people were still, signing up to buy at that point. And eventually this actually got stopped by the SEC. They stepped in and said, no, we don't like this, because they think, or they thought rightly, I think, that this was going to hurt investors who were buying this stock. So they put a stop to it. But even though this particular deal has been stopped, there's a lot of other speculative behavior that's going on, and it doesn't make a lot of sense, frankly.
Yeah, definitely. Again, gives you a glimpse of the little bit of the madness that, or I say a little bit, but a lot of the madness that we've seen in the markets as of recently. So, airlines, Hertz, trying to make bets on these companies, likely not a recipe for long-term investment success. So, for investors or our clients here, maybe you could talk a little bit more about some of the positions that we are holding and that we do believe are the building blocks to a long-term successful portfolio that will compound itself over time.
Yeah, so I still really like, we have positions in Alibaba and Tencent, both of which are technology companies that are geared towards e-commerce and online and mobile activities. They are not impacted greatly by COVID-19, if at all. They are actually helped by it, especially with Alibaba, because people are buying a lot of their goods and their groceries and stuff through e-commerce and then just having it delivered. So that business is going well, and the share prices have done, especially recently, have done very well. And I continue to like the relative valuation of them. I think there's more upside to be had there. Um, there is the concern with both these companies that they are Chinese companies, and there's a lot of um, friction, I'll say, between China and the U.S. and China and Canada right now. So, there is always that concern when you're investing out of your own country. But putting the politics aside, because I think the politics are very difficult to predict. The reason why we continue to like these businesses despite this sort of political overhang is that they don't make any money, or very, very little of their money comes from North America. Most of their money is made domestically in China. So, tariffs and trade disputes don't really impact their business at all. And because China is such a huge market, they don't really need to go abroad. I mean, they are going into other countries in Southeast Asia and places like Russia and stuff like that. And they're making inroads there, especially with cloud and stuff like that. But they don't really need to. It's good that they are, but they don't need to because China has 1.3 billion people in it, and if you put all of Europe and all of the United States or all of Canada all together, that still is like half of the population of China. So it's just a huge market, and these businesses dominate in that market, and there's still room for them to grow. And so I really like it, and the fact that they're not really impacted by COVID, they're actually helped by it, is just icing on the cake for investing in those businesses.
We may not like the actions politicians in China and the U.S. are taking that are kind of stoking the tensions that we see between the two of them. But I know we've had discussions and with these two companies in particular, we think they're great long-term companies that will deliver a ton of value to shareholders and our clients. So I know they're companies that we love to speak a lot about here when we're at work. With that said, we talk a lot about the tech businesses that we own, and they're fun to talk about, and definitely are sexier positions in the portfolio. With that said, it is some of our positions in some more traditional industries that have seen some of the largest that have been some of the largest drivers of our returns, at least over the second quarter here. Maybe you could elaborate a little bit for clients on some of those positions there and what they look like.
Yeah, just one more point on those two Chinese companies too, because you triggered my memory with your question there. There is, if you're talking about the geopolitics, and if people are concerned about that, there is, China, the Chinese government has certainly done things that, we in North America do not like and shouldn't like. But the companies themselves, I think, are actually been a force for good in the world. They've donated billions of dollars to causes, including COVID relief. Alibaba's and both Tencent and Alibaba have been donating masks and medical equipment all over the world. So, despite the fact that their government may do things that we don't like, I don't think that disqualifies us from investing in the businesses themselves. So back to your question, though, what aside from technology, what is still good to invest in? I continue to like our energy businesses. Energy has been kind of a focal point for this crisis because the price of oil, it was really hit with a double whammy because there was a drop in demand because of COVID, and then on top of that, there was a price war caused by sort of breakdown of the relationship between Saudi Arabia and Russia. And that was quickly resolved because they quickly realized that the price war was doing more damage than it was worth. but you did see drops in the price to really unprecedented levels, and in fact, negative levels. The price of West Texas Intermediate was negative $40 at one point. So that's kind of crazy and kind of an extreme situation. But the prices have really stabilized, and we took the opportunity to add in a position, and that we bought a company called Canadian Natural Resources, which is a large Canadian producer. They are the creme de the creme of Canadian energy. They have a very strong balance sheet. They have very low production costs relative to their North American competitors. So even at the relatively low prices that we're at now, which I think today the price of a barrel of oil is $39 or thereabouts. Canadian Natural Resources is profitable at that level, and their stock price is off probably 50% still off of where it was at the start of the year. So I like that business a lot. I think there's a lot of upside potential there. And our other energy company that we've owned for a while is Whitecap Resources, and similar to Canadian Natural, they are profitable at the current prices. Now that's factoring in that they have hedges on their portfolio of energy, so they've hedged the price for 2020. But they are, again, a low-cost producer and of high-quality management, high-quality assets that they own. So notwithstanding that both of these companies have really, their prices of their stocks have come down a lot, I continue to like them. I think that they are going to do very well, even in a very challenging environment. And if there is any kind of upside in the oil price, which I'm not predicting, but I think is very possible that, typically the way the price of oil goes is in cycles. So there's a saying that the best cure for low oil prices is low oil prices, because what's happening right now is production is getting cut. Nobody's drilling in North America. Companies are going bankrupt in the U.S. So that's going to lower the supply of oil going forward. And the demand is a bit uncertain right now, but we have to assume that the demand is going to return once the economies start to reopen. So there is a potential that prices could even spike up again. And if that was to happen, then these stocks, both Canadian Natural and Whitecap, are going to go through the roof. So that doesn't need to happen, but if it does, it would be very good for us, obviously.
Needless to say, we obviously feel there's a lot more upside potential than downside in the two companies that we own, and we've already seen a tremendous rally in them in these past 3 months. As I alluded to there, they've been big returners and big performers in the near term here. Although we're, the way our philosophy and the way we manage our clients' money, we're not known to make many big changes or frequent changes in our portfolios. However, this quarter, given some events and what we've seen with respect to interest rates, we've begun to trim a lot of our clients' fixed income allocations, redirecting this capital to different alternative asset classes. I would love for our clients to kind of hear from you on what we're doing and why exactly we're doing this and reallocating what often clients believe are their safe investments into these alternatives.
Yeah, so this is a very complicated topic because trying to price bonds and the price movements of bonds is just not a very intuitive thing. But basically, what's happened in the world is that interest rates have come down pretty much across the board in every economy. And when interest rates go down, the prices of bonds go up. And so our bonds have risen over the last well, basically bonds have been going up for 30 years, but yeah, especially in the last 6 months, bonds have gone up because interest rates have been going down. And the flip side to that, though, is that when you buy a bond today, like if I bought a Government of Canada bond, say a 10-year bond, the interest rate that I'm going to get paid on that bond is somewhere in the neighborhood of 0.5%. So I'm going to get paid 0.5% on my money, and that's not very good. I don't think there's too many people who are going to be satisfied with 0.5% of their returns before taxes and before any fees that they pay. So what we decided and what we made the call to do is we've basically trimmed our bond positions, and we've looked for alternative ways of protecting our money and sort of dampening down the volatility of clients' portfolios. And part of that is because of what I was saying about interest rates. Part of that is because there is significant risk in owning bonds in a low interest rate environment. If that same 10-year bond that I was talking about, if I own that bond and let's say interest rates went from 0.5% to 2.5%, well, that bond, the price of that bond is going to go down, and it's going to go down significantly. And you could easily see a 10 or a 20% drop in the price of that bond. So people kind of, I think, see bonds as their safe investments, and they don't want to hear that they could potentially lose 20% of the principal value of their bonds. So, and we decided for clients that we need to do something to try and protect against a scenario like that happening. And the way that we do that is investing through alternatives. And alternative investments are things like hedge funds or maybe things like real estate and commodities investing. It's not a perfect solution because those investments have their own risks in them. But in changing our mix a little bit, we've kind of diversified away from the risks that the investment, sort of the interest rate risk that we had in our bonds. So this is there's a lot of experts who spend a lot of time thinking about, things like this and the price of bonds and where interest rates are going to go. We are not trying to predict that interest rates are going to go up, but what we are trying to do is protect ourselves in any eventuality. And this was a way of doing that, is just taking some of that risk off the table.
You talked about a situation where interest rates might rise, and like you said, trading kind of one risk for another, getting rid of some of that interest rate risk that maybe lies within the portfolio. Maybe you could just shed some light on why you have a concern with the interest rates rising, just given what we've seen with governments around the world and spending during this COVID era.
Sure. So interest rates are intimately connected with inflation rates. So as inflation rates go up, interest rates typically go up. The Canadian government announced yesterday or the day before that they were going to run a deficit of somewhere north of $300 billion this year, which is, I don't know how much bigger, but it's much, much bigger than any previous deficit. And it's basically going to add 30% to our national debt in 1 year. The same thing is playing out in the US. Their deficit's going to be over $2 trillion this year easily. And same thing happening in Europe, in Japan, all over the place, basically. So what that means is essentially that governments are printing money. They are expanding the monetary baseline. And there's more money being created, and with more money being created, it is an inevitable consequence that inflation will go up. It may not happen immediately, but one, you cannot print money to the level that we have without there being consequences in inflation. So we are not in the business of predicting when that is going to happen. I have no idea. It could happen, next year. It could happen 5 years from now. It could happen 10, 20 years from now. I don't know. But I think when it does happen, it is going to have very serious consequences for, the prices of bonds, prices of a lot of things, but bonds in particular. And we felt that it wasn't worth, there wasn't enough upside in owning those bonds to justify the potential downside.
That's great. Well, with that, Craig, I think we can close off this Q2 update for 2020. Definitely appreciate you taking the time today and providing your insight. I know we've been doing a number of reviews with prospective clients to provide second opinions on portfolios and the way they're positioned and as well their financial plans. So should anyone have any questions or concerns about their own portfolio or clients, always feel free to reach out to us. For any individuals who aren't dealing with us that also may have concerns around their own portfolios and plans in place, feel free to reach out, and we'd be happy to sit down and provide you a second opinion on your portfolio positioning and those financial plans that you have in place. So wanted to let everyone who watches this video know that that's open, and that an Endeavour Wealth Advisor would be happy to discuss. So again, thanks again, Craig. Signing off. Look forward to doing this again Q3.
Thanks very much.